Hello, hello guys. How are you? Can you hear me?
Yeah, Empanada, how you doing?
Very good, very good. How's everything going?
Good, okay. It's good, okay. How was your trading day?
It was pretty good. It was quiet. Um, I didn't want to participate too much today because I wanted to wait for a direction and wanted to see a little like what was going to happen with Nvidia and all of that. So I was kind of a little bit quiet today.
Yeah. And the Apple stuff was crazy. I guess
Yeah,
people
yeah.
people were not
I traded.
impressed.
I traded. I mean, I did a couple of scalps on Kava. I traded Kava. I traded Apple. I traded ANF, Abercrombie and
Okay.
Fitch. I traded what was one more, I think, and the XOM that Nando called.
Yeah, that's been going up and down. I took one of those.
Yeah, that one was pretty good. But
Yeah.
besides
Did
that,
you trade 'em already? Or
yeah, I mean, I'm out of all of those
okay.
except Apple and which is the other one that I'm holding still? Mm, 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 mm. I think
What?
AMD. I'm still holding some.
Okay. Oh man,
Yeah.
lips. I thought you did something on lips before.
Yeah, we did. We did. This is a repeat because we're trying to, there's some new, like, there's a time, like, we do 5 classes per week. And
Okay.
that's like, 20 classes per month. That's 240 classes per year. It's pretty hard to have different subjects when we have people coming in on and on.
Yeah, that's
So
true. That's true.
we're trying to make a cycle where we can advance on subjects, but we can also have some subjects, for the new people that is getting in and try to have a sort of a um, go all over like the basics and do like yeah, I think cycle is the best way to describe it. So we can start again with levels, TOS setup, how to use the different indicators, etc., etc. So sometimes I mean, there's no, except if you go very, very deep into Greeks and other more definition sort of styles, like
Uh-huh.
most of the members would like to see is trading. Like, let me see the charts, let's see like what's happening. So we try to the mix on how to make the lectures interesting for everyone to learn, but not make them boring and make them efficient.
Yeah, that makes
Sometimes
sense.
it's tricky. It's a tricky.
Yeah, that makes sense.
But we have been over this. But I mean, we thought that it was a good time to go again over Lips because what the market is presenting right now could be if we keep on going up and we still breaking up on SPY, it
About this
might be
beautiful view.
it might be a good a good way to start building up again
I
your
thought you had to
point.
get powdered. Yeah,
Yeah. Yeah, that makes sense. I mean, maybe we
I
can,
thought she said
I
she's
mean, the
powdered
class
to
are not the
remove the
same thing
house
every
shit.
time. So you can talk about something else that maybe somebody didn't pick up the first time. So,
Yeah, and it's I mean, I like that very much because a lot of us like like right now it's a time I feel a little bit like we are right now on a what happened on 2021, that we were at the peak, like between 2020 and 2021 we were at the peak in November of 2020, and then
mhm.
2021 we start like going down, and 2022 we start going down in the market, and then 23 at the beginning everything start going up again. So if you were on cash at the beginning of last year and you started buying, Nvidia, Apple, Meta, all of like a lot of those technology, that I mean that was the time to buy. That was the deep
Mhm.
to buy. So that's a great play that if you did not have enough money, you will be able to, profit a lot on leaps,
Yeah.
because you could buy like maybe 2 leaps on Nvidia, 2 leaps on Meta, and maybe one on Apple, and you would have some exposition to the move that happened because everything went like 300% up.
Yeah. I need to. Yeah,
So
it's a good
that's
idea. I need to learn more on that. I don't really take that much leaps, but yeah. I need to. I want to start.
And sometimes, Laura, you don't even need to hold it for the whole year. Sometimes when you grab so much time, like the move on that contract, it's so good that maybe after a month or 2 months, you can just take it and it's a 30% without risk.
You look nice.
That make nice.
I'm doing 3 eggs. You want pepper, green pepper?
I'm muting Teresa. Your microphone was on, so I muted you. Sorry. I'm waiting just to see if we have a couple of more people here. And we start, guys. How was everyone's trading today? Payday, large cap to small cap switch already started. Nice. Hello, swing. Yeah. Some interesting moves today. The other one that I play was Morgan Stanley today for a quick scalp. Morgan Stanley paid pretty nice today on a sort of like a triple bottom. We will go through some charts later on. But let's see, let's start. All right, guys. This is gonna be a little bit of a basic sort of lecture on what leaps are and how to use them. And I think that they are a great instrument on like when we're starting to not only to trade it on daily trade, but if you're building up your port or rebuilding it, because sometimes you restructure your port, and if you have gains in certain names, you want to see what you're going to do with your money. So we start with leaps, could be a great way. And just on the basic side, leaps is a long-term equity anticipation. So these are options with expirations that extends over 1 year up to 3 years. Sometimes we do it on 6 months. It's not a set specific time. It's just long term. So it doesn't matter if it's 8, 9, 2 years, or maybe 8 months or 7 months. There are contracts that you're gonna leave there for a longer term. There's not gonna be so much volatility, and even though the premium is gonna be more expensive, it's a lot cheaper than if you need to buy the amount of securities or the underlying stock that we're talking about. So we'll go through this and why it's a great tool. To refresh the definition of an option, a leap grants the buyer the right, but not the obligation, because you can always sell your contracts to purchase or sell the underlying asset at a predetermined price on or before its expiration date. So basic stuff. Then why we use leaps. One of the advantages of leaps, let me see one thing here. Okay. The advantages is we use them for a longer time horizon. Like, like for example, if we were in 2023 again, and I'd like to use that example, and you didn't have the money to buy 100 contracts of NVIDIA, but maybe you had to like $2,000, you could have buy a leap on NVIDIA and grabbed some of the 400% move that NVIDIA did over from last year until this year. So that's a great way to use it. And the only difference is going to be is like, except instead of paying like $400 or $300 for a weekly or maybe a 2 weeks contract, you will pay a couple of thousands if you are close to the money. And sometimes when we play leaps, we don't need to be as close to the money. That's the right choice. The closer at the money that you are, the best, the contract is going to move. But you can give it a little space because you're buying time. So it's not going to move as fast. So the lower time decay that you're going to receive in that contract, this theta, is going to be a lot slower compared to what we trade normally on day trades or when we scalp. So leaps are going to be less susceptible to value loss over time. So if you invest $1,500, it's not going to happen like if we traded today NVIDIA, that the contract could have gone down completely and you lose 80% of the contract. If you have a leap, and with the movement that happened today, probably out of a $1,500, maybe you were down 150, maybe $200 tops, and then the same contract was going to move up enough to have that to capitalize that amount again, and then try to see if we were green and have a great ROI on that. So the other thing why we use LEAP is leverage. We have the ability to control large amounts of stock with small investment. And we'll go into examples of why we use these LEAPs and why do we use them a lot more. All the time, of course, this is an example of why do we buy LEAPs. We buy LEAPs on a stock that we believe, or either your analysis or your your research thinks that is going to be appreciating significantly, or in the next 2 years, 1 year, the amount of time that you think that contract or name is going to appreciate. And then we're trying to make a bet that paying upfront is going to make us some money when the next the price goes if the price goes in the way that we expect it to be. So this is an example. We have a 25 strike price for a GE call option. That means that for 100 shares of GE at 25 at expiration, if we want to exercise that 25 option and the market is higher than the strike price, what we're going to invest is going to be less. So we can expire and lose the price of the premium paid. And also remember that, for each put or a call option contract equates to 100 shares of that contract. So if we pay for a 25 strike on GE and the price of GE goes to 30, there are two things that we can do. We can just sell the contract, or if we want to hold to those shares, we can exercise our contract. The market it's at 30, but we are buying it at 25. And then if you want, you can just reverse that and just go to the market and sell your 100 shares at 30. So there are different ways on why you would like to buy those LEAPs and why you want to use that as a tool for your longer term portfolio. Here is some of the strategies that we use while buying LEAPs. Sometimes, when we buy calls, it's just for substitution for buying the stock, instead of having to put so much money on 100 contracts or 100 shares. We can just buy, 1 LEAP, 2 LEAPs. It's just a name. It's just a call option with a longer expiration date. And then we can just appreciate for that small initial investment. So if we have X corporation trading on 100 and we buy a LEAP with a strike price of 110 that is going to expire in 2 years or 15, if the X contract goes to 150, our call option is going to be worth 40, because we have the difference of what we pay for what we paid and what the actual price is. So we're making $40 per contract, generating a significant return. So this is why we use it. It's just the same that we did, like we do it for daily use, but on a longer time frame. So this is how you can make your day trading, just scalp certain names, and then on longer names, like some people don't like to daily trade Apple. They just rather buy longer term contracts. They buy LEAPs, they buy 6 months, 3 months contracts, and just let, from 160 something that we were, 165, now we're reaching 198, trying to go to the 200. So that $30 that the people, some investors will try to get out of names like Apple, that they move slower, they pay slower, and it's not that expensive compared to the chips and all the other technologies that we have right now. Another strategy that we can use is the cover call. So we can write LEAPs. So we can sell a shorter term call against them. So if we have a LEAP, we can sell another call against it, because we are the owners of 100 shares of a contract. So this is pretty cool, because sometimes you don't need to have the amount of money to do this strategy. But if you pay $1,000 for a certain amount of time, and you are the owner of 100 shares of, let's say, ABC Corporation, and you bought a call strike price of 100 that is expiring in 2 years, but then you can sell another call with a strike price of 120 for $3. So if the stock stays below 120, you keep that premium until the 1 month call that you're making it. So that you're not only making money on that short-term cover call that you sold, but then you're making money on your LEAP that's also going further up. So I I don't know if that was clear, but you can buy a longer term, like a 1 year contract on Apple, and then you can play against it, and you can sell calls against your same contract that you have there, because you are the owner of that contract for a year. So that's a pretty cool technique of almost, you don't need to have too much money to use these two techniques to handle 200 shares of Apple or X corporation that you like and make money both ways, because you can, sell the 1 month call and make money out of the difference on the premium that someone is going to pay. And then on your lip, if the price keeps going up, you're making money too. So, hey, it's a great way on how to use leverage, and you don't need to have so much money involved. Of course, you got to be right, and you got to be the price of the underlying names or stock needs to go your way, because if you're buying calls and the thing goes down, well, there's nothing that we can do there. That's why you have to be very careful on the names that you buy. And then some other investors will use the leaps for hedging. For example, if I own 100 shares of, again, let's say Home Depot, and they're trading at 80 right now, and then I see that the price action, it's not going up, the way I want, I can buy a leap, but I buy a put with a longer strike, maybe 2 years or 1 year, and the price is going to be 75. So if Home Depot drops to 50, my put option, like my long-term put option, is going to offset the loss that I have on my 100 shares. So this is mainly this is how I use leaps and why I use, hedging. Like if you have a long-term position that is bigger than 100 shares, it's always great to buy, some puts against them, just to protect the movement and the flow that it's happening on that price, because the price action always go in sort of ups and down waves like this. So when we're up, you can buy, you're on the way up, you're buying shares, but to protect your shares, because you don't want to sell them, if you want to keep holding that position, you can buy put options and just hedge against them, get out of them here, and then keep buying shares, and it's going to minimize your price per share on that position. So that's a great way to do it. Great way to do it, guys. Any questions until here? Anyone? No? Keep moving. Is anyone using leaps, or is hedging right now using leaps? No one? Okay.
No.
Yeah, I am.
Okay. I just want to know, you guys, like, it's people, really protecting their ports. Remember, we're going up right now. We're going up, but there's gonna be a time that we're gonna come down, and the market needs to take some air. It's gonna be a healthy pullback, and that's when we use these sort of techniques to protect your investment, unless you were buying no shares and you want to get rid of them, and you're okay with, you're 40% up and you're okay of taking your shares and just move that money to another name that it's at a better price. That's awesome. But if not, remember, you can use these long-term contracts to protect that position, and you can profit both sides, up and down. And then this is for the synthetic long stock. This is the same that we were talking about. You can create
come on.
a synthetic long position by buying leaps calls and selling leaps puts at the same strike price. So we can simulate that the stock, but potentially with less capital and defined risk, we can simulate that we have it, but we're just buying contracts, for a fraction of the price. As if I want to buy right now, let's say when Nvidia was at 1,000, and I want to buy, 100 contracts, I don't have that type of, maybe you don't have that type, or I don't want to expose that type of, amount of capital at the moment. So I can just buy a call and then buy at the same price of a put and just sell it against it, and then creating a synthetic long position. So if the price of that name that we're buying rises, my synthetic position is going to gain a value similar to owning the stock. So it's a great way to do sort of a straddle on those. So that's just another way. Then we can select how do we select the right lips? So we have to know, like, for example, if you want to buy lips on GME, it's very risky. I wouldn't buy lips on GME because I don't know what's going to happen. And I'm not Roaring Kitty, so I'm not prepared to, expose large amounts of money on contracts that I don't know, or if they're going to be too volatile. So you have to look the fundamentals, of that name that you would like to invest longer term. You got to see the volatility, and you gotta see the strike price that you want to see, and we will see that later on sorry, when we move to the charts. I'm gonna show you more or less, like, we can anticipate with some of our technical analysis where our contracts, or where are the move that we're expecting that it's gonna be, and try to see and buy those contracts. Another way that we have is by analyzing the Greeks. We have delta, theta, and vega. I don't know how much we haven't. This is like a little more complex, but delta, it just measures the sensitivity of the stock prices. A higher delta means that the option will move more like the stock, so high volatility. Then theta indicates the time decay. Theta, it's the one, for example, that every time that you guys want to buy a SPX call at the beginning of the day and just leave it the whole day, theta is the one that is gonna consume your contract. Even if we, like, every time that passes, the move on SPX needs to be stronger and faster, so the contract is not going to lose. Maybe sometimes you have contracts that are in the money that are negative because they were consumed. So you got to be really careful with that. And vega is going to be the sensitivity that the volatility changes. So the higher vega means that the option is more affected by changes in volatility. Swing. Did you grab everything that I say on the hedging with the lips? Are you clear on how do we use the lips for hedging? I have a question here, guys. Swing is asking, like, how do we use hedging? How do we use the lips for hedging? So as I said, Swing, we use them for longer term exposition. Even doesn't have to be shares. If you are buying, for example, delta, and you have, maybe 3 longer term delta calls, and that you're betting that delta is going to go up on the next 6 months, and the market's coming down, the only thing that you'll do is you don't buy delta puts. You can buy, QQQ, or you can buy SPY puts against it. You just need to buy it with a longer term, probably, than your contracts for delta. And then you got to be very careful which contracts do you buy. Normally, I like to use open interest and volume on my choice of contracts, and because I want to have liquid contracts in case I want to get rid of them. And we talk about that in another lecture, but open interest and volume, it's a great way on how to choose your contracts, and then you can get a little more in depth by watching the delta and the Greeks in general, depending on what your strategy is. Is the only index better to hedge or stock for lips? Is the only index better to hedge or stocks for lips? What do you mean by that, Swing? If it's the only index better to hedge or stocks for lips? Can you please?
So the question is, when you do hedging and try to protect the other side, usually everyone is hedging the index, but can we do a hedging by having the stock as the lips?
Yeah, you can. Okay. But the problem is that you try to see, like, if the market's coming down, normally the ETFs are going to be the ones that go down. So just to make it more general, because if not, you gotta be on point on, for example, let's say, I don't know.
Let me give you an example. I have a SoFi 2026 January calls.
Okay.
And I'm not worrying that it's gonna be up within a few months. So I did a shorter time frame puts.
So today's
Yeah, so the shorter time frame for the 2-3 months I did a puts as a hedging, but
Yeah.
main goal is a calls for the 2026. So
Yeah.
that's
Yeah,
how.
that's
Is that the right way?
yes, that's perfect. As I said, there's no a specific technique exactly because you can do shorter terms for hedge and then keep on moving them. You know, you can make the gain that you want, and then you can either roll them or just buy new contracts if the move keeps going down just to hedge it. But if you have a change or a reversal on that move that you're expecting from the stock that you're protecting, then you can just add a couple of contracts to that position and then, average down. So yeah, I mean, there's so many, like one of the things that we have here, guys, investing is that there's so many different ways to manage our portfolio with different instruments. There are thousands of different styles, techniques, and tools. So, but yes, the main idea is if you have a position that you want to keep having and in the longer term and the market is coming down, you can protect it by either, buying puts for the same stock. You can buy leaps longer term to protect the whole portfolio. But there are ways on how to profit the market up and down. And then the idea at the end of the year, it's that our average up and down, it's higher than the market and it's higher than what, having the money on the bank. So that swing, that's good. They're great. And that's a good contract. So on spot there. So now we come to one of the main problems sometimes that I find on a lot of people that I have one-on-ones with is they get into a lot of positions. They got, maybe a mid-sized port, and then it's all messed up on how do they manage your positions, and it's really complex. Like, how do you avoid trying to jump into more positions, and then how do you keep managing the ones that you got? So then if you buy 4, 5, 6, in one jump, how do you manage that all of those are going to be there? So you got to be very careful. You got to be, I always like to have like 1, 2, max 3 positions at the same time open, unless it's in the longer term port that, that's, we just leave it there. We try to, whatever gains we have on the week, you buy some shares and just leave them there. But you gotta be, careful with the risk involved in the management. You gotta buy contracts on your lips that are liquid. So in case that you wanna get out of them, that you're gonna be able to do it pretty fast. And then one thing that you need to bear in mind, leaps sometimes they have a lot bigger and wider bid and ask spreads. And then one of the things why is because sometimes we don't have enough volume and we don't have enough open interest on those contracts because they are far away and people is not getting very interested. Sometimes we have like, I don't know, $35 points on different between the ask and the bid. So that's the same thing that happens sometimes when we buy SPX. When we buy SPX right now, and then you buy it for $40 and then keeps going up. Now you see your profit is at 140, but when you see the bid side, the bid it's at 80. So you think and your P&L says that you are at 150, but when you click sell, it got filled at your bid. And the bid was $40, $50 below that. So you thought that you were, making that money, but the truth is that the bid was $40 below, and that when you sold that gains, you're either negative or you're not even in gains. So we got to be careful with the leaps on that, with the spreads that you're buying, and when when you get in and when you want to be out to break even, or if you're in profits. Then you want to diversify, the spreads investment across different stocks and sectors to manage risk. So if you have, maybe $5,000 that you like to do something different, you can buy maybe 3 leaps on different industries. Like you can buy one in tech, one in health, and then maybe one in cryptocurrency. And that's sort of a micro port with just 3 exposures. But then if you have maybe different ETFs, you buy QQQ or do you buy Beto and then another one for healthcare, that's a great diversification with a little money that you can have on a sample port with, you don't need to buy 40 shares of each of it and try to see how it goes. So that's how you can play around with those. It's really good. And then you use always, no matter if it's leaps or anything, use your stop losses, guys. Always protect your investment. You remember, we're trying to make money every day here, but the first thing that we try is to protect our capital because we don't get paid to do this. We are exposing our money and we need to protect it. And we need to be very, very, very protective with every time that we click, buy, we're exposing the money that we have to get to be lost. So be careful and protect your money. Samples, just examples of how, little leaps on a text talk and, how to sell some writing leaps. So we believe if TECO will rise significantly over the next 2 years, we can buy a leap with a strike price of 150, expiring in 2 years for 20. The outcome is that if the underlying name rises to 150, my call is going to be worth $100, resulting in an $80 profit, which is 100 minus 20, because 100 is the worth, 20 was the price that I paid, and that's going to be my profits. Same thing here. This is just little samples that I'm not going to go through in detail. Conclusions. Pros and cons of leap. The pros is a long time frame allows selling of an option. Use the hedge as a long-term holding for a portfolio. Available for equity indices. The price is less sensitive to the movement underlying. So everything that we have talked, I love to use leaps. I like to trade them. I like to use them. I don't need to hold them for a year, 2 years, 3 years. You can hold them for a month, maybe 2 weeks, 4 weeks, 5 weeks, and you will make a lot of money with it if you are on the right side of the ticker that you're trading. The cons, well, premium is going to be a little, more expensive, but then do you rather have exposure on a name on 5 shares, or you can have 100 shares of that name, depending on your, port size. It's going to be a peculiar decision or individual decision, depending on the amount of money that you have in your port. The long time frames ties up the investment in dollars. Well, yes, but you can always sell the contract if you need it. So this is not, set in stone. You can always sell the contract, grab your money, and just reinvest it in anything that you need. The markets move. So this is where we have to cover our risk. We need to be careful because we might be, betting that NVIDIA is going to go to 2000 or 200 now. And then normally if we see most of the names that have gone into splits, they go down for a little bit. So yeah, you can trim on lips, Rudy. If you have multiple, like it depends on the size of your investor. They're like the bigger guys, they don't buy 1, 2 leaves, they buy hundreds of leaves. And then, that's thousands of shares that they're exposing instead of buying those shares. So that's a great way on how to have exposure to that name with a lot less money. So if you think that, you're 30% and you still have more time to go up, of course you can trim and then just, not only recover your initial investment, but then just leave, gains to be risked at the market. So yes, we trim leaps. Leaps option, I mean, how deep in the money strike versus expiration need to look. How long do you consider a leap? Leaps are normally considered a year, Rudy. Normally for a year, but for me, everything that it's higher than 6 months, I will call it a leap. But normally it's a year, 2 years, and 3 years. That's what the rule says. What else? I'm gonna stop sharing here for a second and I'm gonna go into, let's go. Okay, hold on. I'm gonna share one more here because I think this is useful. This one's gonna still be useful right now. this is the example that I'm trying to make. Like, for example, if we have 100 shares of whatever, and that's gonna cost us $160 per share, we're gonna need 160, sorry, 16K to have those shares and have the move that we want. So this is if we have shares on Apple, and this is if we bought some options or leaps. So the move that we had, this is a move that happened on May. On May, if we grab the lowest at 16.9, the contract went all the way to here. Our shares were from 169 to 190. That was the move that Apple did. If we bought, you know, at 189 and then divided by 160, that's the price that we pay, we have an 18% gain if we bought shares. But if we did exactly the same and we bought options, the amount of shares that we had compared with the gains that we had here, the contracts went from 16.9 all the way to 34.7 on calls for for Apple. So I had a gain of 100% was my ROI with less money that I invested. So this is a great example on why sometimes, even if you wanted to have exposure to a name like Apple, having leaps on the shares with the IV and everything makes a lot more money than just having the old-fashioned, you know, position in a longer term. So this is a great example of that. Let's see, let's look now. I'm gonna stop sharing. I'm gonna connect to TOS, and we're gonna see some contracts, and we're gonna see some examples right now of the current market where we can do that. Give me just 1 second, changing. Installing updates on my TOS. Okay, there we go. Yeah. Let's do the setup here, and gonna move this down here. And let's do some names. Let me just close this. And here we go. Let's see where we are. So I'm gonna share my screen here, guys. All right. Sorry for the delay. Okay. So this is my normal screen. And this is how I use it. Let's see what we got here. So that's fine. I'm gonna expand this. And let's talk about Amazon, because I like Amazon right now. If we go to Amazon and we see, you know, look at this move on Amazon. Look at this beauty. We traded Amazon. I traded Amazon today here. Look at this break on Amazon. I were looking from the entry today. And I said it, I commented on my tab. I said, the great push of 184 all the way up. But imagine that we were right here. And 175 to 185, 10 points, you know, expecting this break. What if I think Amazon can still go. Gonna grab more days. I think Amazon should go back to 190 because we have this sort of double bottom here. Sorry for these are my channels. So look how the channels broke up and broke down and broke up. So I love to use channels visually. And then if we were here, guys, and I believe that, you know, my price target is going to be 191.32. What are the things that I'm going to look for? Let's say that I'm going to start looking for a little, I can go for January 25. And what price I'm going to look for? Because some people, like, you got to be careful with just getting whatever you can pay. That's a problem if you're just trying to do that. So this is where it gets tricky. Do you want to have exposure to this name? You need to, you know, the premium is going to be higher. But remember, you can always sell this. You're not going to lose this like what happens with a same-day contract. You're going to lose this if there is a radical move and then the market goes down and you did not manage your position. So there's a lot of time to move. And sometimes that's why it's easier just to, you know, it's get some more exposure to that, to certain names. So, and the other thing that we need to see is what my chart's saying. If I was around this area, but let's say that I'm here and I want to buy it to 191. If 191 is my price target, I need to find a price action or a contract that is close to where I'm thinking that it's going to go. I cannot buy at $400 or $300. I need to buy something that is going to be, you know, coherent with my chart. And let's see, what else do we have here? See, 181. Look at this move that we had on the week. That this is going to be. Imagine having it buying at 81, and we are here at, you know, 100%. But instead of having, you know, to spend, you know, $8,000 here, you could have buy maybe 2,000 for 100 contracts and then profit all this move. But since we're here, we can always look for. We're saying that it's going to be somewhere around 191. So let's see. We're going to be 191 is my price target, between 189 and 191. So I can go here and for, let's say, January 25, or our next January, I got to be somewhere around here, guys. Somewhere around here. I can, since we're buying a lot of time, I look, see, there are certain contracts that you can risk to go a little bit out of the money. Like, for example, the 210, and I like this. And even look how interesting this one is. 240, which is very far away from where we are right now. But this contract, by having this open interest and having this volume, and the spread is just $10. It's gonna move very nicely if you want to have that exposure for that long, you know, that longer time. So it depends, as I said, on your, how do you want to manage it? And of course, that the move is going to keep going your way, but you can, I will go, you know, all the way until here if you want to have that exposure. If you have more money, of course, that getting anywhere on this side, if you get to 190 or maybe the 195, and you're expecting, you know, that 195 is not that far away, but every move that we go this way, your contract is going to be, you know, the IV is going to be nice, and it's going to be paying more. And if you get in the money for the next 5 months, well, there's nothing that you need to do. You're just going to wait, and you're going to be somewhere around here. Just, you know, once you are in the money, volatility kind of, you know, it's gone. So it's really, even in SPX moves, but in normal stocks, is not going to be as volatile. So it's really, really nice to, you know, have that long-term exposure and just be calm here. But if you don't have the money, I will go until here. That will be the furthest that I will go. It's far away, but you're buying a lot of time. What else? What other name do we can see that it's going to be something like that? Apple. Then you see, if we're, where do we expect Apple to go? 200. Look at the move that we had today. Huge move down. We thought that, you know, why? Well, we know that this is a known. Look how do we reject it here? 1, 2, 3, 4 times. So this is a known rejection point. It wasn't really strong. So I wasn't expecting the thing to go a lot higher, but since we knew that this was a hard, you know, reverse point, it should have been a great place to buy puts, or hold, see if we go back to, we have the 20 daily SMA here, and then this thing is going to go back to probably 200. So again, another example that as I talked, look at the move that Apple had from here to 164 all the way to here. We could have gone into, got some of those leaps around this area in 160. But if I'm buying and I'm betting that it's going to be back to 200 in the near future, January 17, 200 calls are, look at the open interest on these contracts. Look at how different from the other names, and look at the amount of volume that we have. So this is great. Like, sorry guys, a lot of people is going to bet that this thing is going to go up, and they're not afraid of these prices. So you can, this one is great here for $100. You can just buy a couple of, for $200 you can buy 200 shares of Apple and just let them be here for the whole rest of the year and see if it goes up. I like this contract here, just to let it be. So of course, if you're around this area, you're going to make a lot more money, but hey, for a small port side, you can buy these slips here. So it's going to be a matter of what your port is and the amount of money that you have. But one of the wonders of yeah, Apple event was shit. One of the wonders of leaps is that you can adapt to the price that you have. Yeah. I was expecting Apple to do a lot better, man. Look at that move down here. Look at that move from 197 to 192. We gave $5 pretty fast, and we're coming back to this range here. So you gotta look at this. We broke this. I'm gonna do this because I like to draw my levels this way. You see, look at these guys. We broke this level, stay here, we look below, stay here, stay here, stay here, and then this resistance, it became support, and it seems that we were going to go higher, and then we're coming back to this. So I'm gonna be very, very careful with Apple on the next couple of days to see if it's gonna bounce back on the 20 daily SMA here. If we break down, it's gonna keep coming down. So this is gonna be a very, if you are on leaps, for example, you gotta be careful with this type of moves. But on the next, maybe tomorrow and the day after, you gotta be careful with it has to hold somewhere around this rectangle here. So I'm gonna bet that it's gonna be around 190, 189. If not, we're gonna flush all the way to 187. So gotta be careful with those. The event was not what we were expecting, but it's Apple still. So Apple it's a better place to buy shares and hold than to trade it with contracts and options. What happened to AMD today? Look at this. AMD trading on another. We do the same and we just go into this price action, you see, we're not going anywhere. We haven't gone anywhere. We're just sideways, nowhere. Every time, guys, that you are charting and you're doing your technical analysis, do squares like this, and it's going to help you visually to see what the levels are. So if you see that if tomorrow AMD comes above this, I might take calls to see if we go up, but if it rejects here, we can go all the way down to here because we broke. This is the daily 20. I thought we were going to hold it. We broke it down, so I wouldn't be surprised that tomorrow we touch this. It's going to be a great entry for puts, and then we go down all the way to here. So 153 could be my tomorrow day for AMD. So be careful and watch that. Any other names, guys, that you want to see? Any other questions that you would have on leaps, on anything else? That's pretty much the. Do you use Flow? I use Flow times and times. When I'm.
Which ones do you use? I kind of got out of usual wheels because of the price, but I used to like it. I may need to go back to it.
I use Shadow Flow because I have a discount on Shadow Flow, and I have in my tab. If you see my profile, I have.
You do?
Like
Okay, I might need to check it out. But I'm so used to unusual flows now. I don't know if I should switch.
Yeah, I use that one because it gives me 25% less
Oh,
for the
really?
price.
Wow.
So I don't use the pro or anything. I just like to see the basic things. So
Okay.
sometimes what I do is here on my flexible grid, what I do here is I open my, my level 2s and I see my times on sale, and I just put them here and I start watching, during the day what we have. But this is what I use for trading normally. This is I don't use the active trader, I use the flexible grid because I like to have the chart side by side, and I have the 2 minutes and 5 minutes sometimes.
Okay.
Yeah, so this is what I use. I like to see the charts in depth here, and then I just see the movement here and where we are. No way.
That's a
There are
good
way to choose
question.
leaps, for
Yeah.
example, PayPal. Let's see PayPal. Where are we right now on PayPal? Trying to see if PayPal goes up, swing to that highs here. Let's see what we got here. So if I were to buy dips on PayPal, 175 on the daily. Let me grab more days here. 1 year, 3 years. Let's see what else do we got. PayPal 275. If you're betting that this thing is gonna go somewhere around here, will be my first target, 124. I will go anywhere 124. You have a lot of space here. You see, if you're going to 124, look at all the space that you have, and look at this one. Look at the open interest on 140. Wow, 165. This is interesting. It's not that expensive at all. Probably people are betting that the thing might go up, and they buy, you can buy 5, 6 contracts of this for, $150 and just get in here. And then these things, the more you have, it adds up. So it's interesting. I like this. But if not, I will go for this one. One of these two. I like this one for the price. You can buy five contracts here and maybe get 2 of this if you want to. Of course, the closer that you are at the money, the better you'll be. But with the time that you have and the amount of here, let me see what we have here in December. July, still people, a fair amount of open interest. Fair amount of open interest. That's interesting. I like that. Let me see something here. See open interest near the money based. Sorry, got it. Yeah, I look at the one of the things that I look is what's the price that I'm expecting? What is my goal? Where's my profit? Like if you believe that the thinking goes back to either here or here at 103, I'll look for the contracts that are, close to 103. So, and you can start, the more time you get, like March. Look at these ones in March. Too far away. So December 24. See, 4,000. The volume is not that much, but I like this ones here. I like the January. I think January is where people is gonna get more interested on it. So I like these ones here. It's not that bad. Let's see. Implied volatility on this. Delta, it's 0.12. Implied volatility is 36. Yeah. Not that bad. I like those. Any other questions, guys, on leaps and how to use leaps for hedging, for investing, for, you want to have exposure to different names and you don't want to have the put the money, you can just buy some premium. If we would have, like, what was great to have leaps on SPY. I wish I bought SPY here and I got some leaps for all this move. SPY, it's a great name to have lips on. The thing is, like, they're very expensive. But let's say that we think that SPY is going to keep going up. How are those prices for a January? See, look at this. Oh, they're not that bad. I will buy some, maybe here, 550, so $2,000. I mean, compare of having to pay, 50,000 bucks. It's a cheapie. It's costly for a small account. It depends. It depends on what names you are, because if you can buy, we buy lips on AT&T, look at the prices here. Like at 19 for AT&T is $70. So everything, like we're grabbing the most expensive names, but look at this. We were at 18 here at 45. And if we want to grab a 18 or a 19, which is not that far away, we can go to this name. A percentage is, it's going to depend on how you have your portfolio structure. Like, as I said, some investors rather have positions in LIBs and having all the, longer exposure and more money. So I will say you can have I will have a 10% exposure on LIBs on different names without any trouble on my part. It's a matter of, I rather move and trade the LIBs a little on and off on the moves that I like, instead of selling my shares, because the shares, what I do with my shares is I cost average up and down. So I keep the positions on the names that I like, and then I move and protect around, and I speculate on more with LIBs or the day trading that we do. So it's a personal preference. But that's why if you have a long position, LIBs are also going to help you on the way down, because you can always protect your port with those LIBs without having any trouble. But I like this AT&T, you see, so it depends on the name. What's the other one that I was watching? I think Crocs is more expensive. Hood, look at this move on Hood from 7 to 23. And look at the prices, they're not that expensive. You want to go for January contracts, $300, $400, they're not that expensive compared with the move and the gains that they think can move from, 3 times being up, 300% up here. So I encourage you guys to play around, go to paper trade if you want. And on your paper trade accounts, you can just go and buy some leaves and see how they move, see how the volatility that they have. And I think you're going to like them. I think it's going to be a tool that once you see how they move, that they move more, like you don't care about all the noise that we have on the 5 minutes and, each move up and down, but just longer term, longer move is more harmonic, I think. So I think it's a great way, but experiment with it. Remember, it's not going to move as volatile as your day trade. So you can put some money on it, see how it moves, and then just get out. And if you have any questions, if you have any, advice on certain names you're watching or certain contracts, please feel free to DM me. No problem. We're not many today here, but thank you very much for sharing the time and wanting to explore LIBs and something new. And whenever you like any questions, guys, remember, we're here to help. We're here to give you company on this journey. It's there are so many different things that we can try to learn, and we can try to use on our reports and how to improve our investing, that sometimes it might be repetitive, but sometimes really good to go over and see new things that we can use them. So please feel free to ask, to DM me, and no, thank you for spending the time with me here. I hope you have a great night. Be careful tomorrow. We're gonna still have volatility. Remember that we have news on the next 2 days between Wednesday and Thursday. So you're not gonna see me trading or being exposed too much to anything until we have that FOMC and everything that we need to know on the rates. That's why the market is gonna be tricky these days. So go and do in and out, and don't be trading anything for long for this week. All right. See you tomorrow at VC, guys. Take care.